So the second part is explaining some economics as well as the financial finance concepts together. So price of an item is the same regardless of the currency used to purchase it. So as I mentioned, there's a one price or a one price law. The law says that if there is no transportation cost, there is no trade barriers, and there's no transaction cost, in that case, what is going to happen? The prices are equal. Only the difference between the prices at different countries are due to exchange rate. So requirement for an absolute PPP to hold purchasing power parity. Transaction costs are zero, no barriers to trade, and no difference in the commodity between locations. The quality is also same. So absolute PPP rarely holds in practice for many goods. Like it is not possible to exist because transportation cost cannot be eliminated. The transaction cost cannot be eliminated or bring it to zero. So relative purchasing power provides information about what causes change in exchange rate. And the basic result is that the exchange rate depends on a relative inflation between countries. So that's a infer that the change in interest rates between the countries are because of the change, because of the difference of inflation in different countries. So we can write it like this way, like estimated according to the relative purchasing power parity, that the exchange rate is the spot rate. This is a spot rate into 1 plus the difference of inflation among the countries with the exponent to t means a time period, like if it is more than a year or so. Inflation, it depends upon the inflation is for yearly, so we can write it. So it's interesting that the difference, the inflation is the future expected exchange rate is going towards where the inflation is going to affect with the trading country, with the trading country. So we can say, so because absolute PPP does not hold for many goods, we will focus on relative PPP. So this is our what we call it as a relative PPP. So here is an example to understand this whole idea. Suppose the Japanese spot exchange rate is 130 yen per Canadian dollar. Japanese inflation over the next 3 years is expected to be 2% per year, and Canadian inflation is expected to be 6%. So you see that there is a difference of inflation rate between the two countries like Japan and Canada. And the current spot rate is 130. So what we can do, do you expect that the Canadian dollars appreciate or depreciate? So you see here the inflation is higher in Canada. So it means that the currency is going to be depreciate. And we see here like since the inflation is higher in Canada, we expect the dollar should depreciate. What is an expected exchange rate in 3 years? So how we can do? We just discussed the formula like expected purchasing power parity or a relative purchasing power parity is equal to spot rate into 1 plus inflation rate in Japan minus inflation rate in Canada, exponential the time period 3. So if we apply this formula, you see here 130 is a spot rate, 1 plus 2% in Japan, 6% in Canada, and exponential is 3. So we see that is going to be 115. So you see the difference, 130, 115. So it means that the Canadian dollar is depreciating, and at the same time, the Japanese yens are appreciating against Canadian dollar. Now, the second thing is the second through which we can explain the change in exchange rate. Examine the relationship between spot rates and forward rates and nominal interest rates between countries. The second reason we explain is through interest rate parity or interest rate differences. The Canadian risk-free rate is assumed to be the T-bill rate, and consider the following information like we have a spot rate, for example, it's not quoted, but it's like 2 Great Britain is equal to 1 Canadian dollar, or forward rate is 1.8 GB over. So it means that the Canadian dollar is depreciating because previously we can buy, so at spot we can buy two Great Britain pounds, but later on we are able to buy only 1.8 Great pound. The in Canada, the interest rate is 10%, and in Britain, the interest rate is 5%. So what is an arbitrage opportunity? So borrow $100 at 10%. So we can borrow $100 at 10% from the Canadian bank. And then what we do? We buy British pound. So we buy 200 British pound and invest at 5% for 1 year in Great Britain. Enter into a forward agreement to lock in your future exchange rate. And we also do the contract that we will sell you after a year at 1.8, right? So what we did, so after a year, what we have a 210 GB convert into Canadian dollar via the forward exchange. So forward exchange is saying 1.8. So we divided 1.8. So we get it 116.67 Canadian dollar. The story is not end here. What we have to do, we have to pay the 10% interest on borrowing of $100. So how much we have to pay? We have to pay $10 as an interest. So 116 minus 10 is 106. And we also have to pay back the principal, which is $100. So what is left with us is $6 and $6.67. So you see, we earn $6.67 without any investment. So we borrow, we buy, we sell, we invest, and then we pay back. So our own money is not involved, and we make a $6. So if let's assume this is in millions, if this transaction is in millions, so it means we can earn 6 million. So that's a possibility of an arbitrage, covered interest arbitrage. So interest rate parity, as I mentioned, that based on the previous example, there must be a forward rate that would prevent the arbitrage opportunity. So interest rate parity defines what the forward rate should be. This is the exact formula that we can calculate. Approximately forward exchange rate is a spot exchange rate into 1 plus R foreign country exchange interest rate minus Canadian exchange rate. That's what we are saying here. So OTs can also be exponential here as well. The currency forward rate is unbiased estimate of the future spot rate. And so when we are saying forward rate, it means it is the spot rate, like 1 month forward rate. It means after a month, this will be the spot rate, right? That we can read it like this way. So unbiased forward rate, if the forward rate is consistent to high, so those who want to exchange yen for dollar would be willing to transact in the future spot market, and the forward price would have to come down for the trade to occur. And if the forward rate is consistently too low, so those who want to exchange dollar for yen would be willing to transact in the future spot market. So the forward price would have to come up for the trades to occur. So this is the way that this mechanism works, that the forward rate is going to be the spot rate. Uncovered interest rate parities like PPP we established here, like the PPP relative purchasing power parity is we already discussed this, and we also discussed the second, which is interest rate parity. So purchasing power parity and interest rate parity. These are the two formulas. So we see these are the two formulas, and we are assuming here that ES1 is equal to F1, which is called as uncovered interest rate parity, or UIP. So combine the formulas, we get uncovered parity, which is 1 for 1 period and for T periods, like the rate of interest rate change. And Fisher, combining UPPP and UIP, we get the generalized Fisher formula, that the change in the interest rate minus the Canadian rate, which is the real interest rate. So this is our interest rate Canadian, and this is an inflation rate Canadian. So this is going to be the real interest rate is equal to the real interest rate in foreign country, right? So this is going to explain here. So if it is not, investors will move their money to the country with the higher real rate of interest. Overseas production, if we are producing overseas, there are two approaches for evaluating international capital budgeting projects. The one is a home currency approach and the other one is foreign currency approach. So if we are using estimate cash flows in foreign currency, estimate future exchange rates using uncovered interest rate parity, and convert future cash flows to dollars and discount using domestic required return. So this is the way that we can use home currency approach in order to determine what is our net present value. For example, here is a case. For your company is looking at a new project in Mexico. The project will cost 9 million pesos. The cash flow are expected to be 2.25 million pesos per year for the 5 years. The current spot exchange rate is 9.08 pesos per Canadian dollar. The risk-free rate in Canada is 4%, and the risk-free rate in Mexico is 8%. The dollar required is 15% uh, internal rate of requirement, or we can investment requirement, or we simply say that should the company make the investment or we not. So, so I stop sharing this one and I want to share with you the screen to show you the Excel file. So you can see Excel file. So in Excel file, we what we did, we write down these all cash flows. So this one is a negative cash flow, means outflow, 9 million, and these are all inflows for the next 5 years, like 1, 2, 3, 4. And this is the exchange rate for these 5 years. And we convert those cash flows by multiplying to their exchange rates. And we see here that, and the risk-free rate is 4%. And so NPV, what we calculated here, based on this is positive with the, sorry, it's a negative with the $2. So we see that NPV here, we are getting 24355, 3.24 negative. And this reflects that this project is not going to be acceptable as a home country approach or a home currency approach. Now let's start to share the remaining PowerPoints. So that's a home currency approach. The foreign currency approach, here we discuss estimate cash flows in foreign currency, then use the IFE to convert domestic required rate return to foreign required rate return, and then discount using foreign required rate. So the main difference between this home currency approaches, we use cash flows in foreign currency using future exchange rate to convert it into local currency, and use the local currency rate for a requirement to calculate the net present value. But in a foreign currency, we estimate cash flows in foreign currency, use the IFE to convert international foreign exchange rate to convert the domestic required return to foreign required return, and domestic using foreign required returns. So convert NPV to dollar using current spot rate. So here is an example. Use the same information as the previous example to estimate the NPV using the foreign currency approach. So when we apply the Mexican inflation rate from the international Fisher effect is 4%, and required return is 15%, plus 4% is 19%, and the present value of the future cash flows is this. And when we calculate the NPV, we get it again, the negative to 1 million pesos, and NPV is 233 by dividing it with the by converting into the home currency. So we get it again, the negative NPV. So in both the approaches, we are getting once. Often some of the cash generated by foreign projects must remain in the foreign country due to restriction on repatriation. When you are doing some operations in some countries, and there are some restrictions, local restrictions in those countries, that you cannot remit all the profit what you are generating. This is what we call it as a restrictions on repatriation. Repatriation of the profit is occur in several ways. One way is to give dividend to the parent company. The other way is that management fee for the central services, like the parent company is providing the software or the standard things for operation in the foreign country. So they can charge fee for that. And the most commonly used form is the franchise, royalty for the use of a trade name and parent. So you have to pay the franchise fee, like McDonald's is operating, Walmart is operating in different parts of the world through their subsidies on there, and these subsidies are going to pay the parent company, repatriate their profit in any of these two three forms, like they can use. Required return for an international project. Should the required return on the international project be different from the similar domestic projects? Depends on segmentation of the international financial market, risk of the corporation, foreign exchange controls, and taxes. Some countries or some regions are called as a tax havens, so the firms love to do their operations there because they don't need to pay a tax there. Sources of financing in raising short-term and medium-term cash. Canadian international firms can borrow from a Canadian bank at a Canadian rate, borrow from a euro bank outside Canada through the euro currency market, often as a floating rate plus LIBOR plus a margin. We discussed the LIBOR. Issue short-term notes through a note issuance facility, NIF. So these are the ways that the Canadian firms operating in other parts of the world can generate finance for their. So transaction exposure, risk from day-to-day fluctuation in exchange rate, and the fact that companies have a contract to buy and sell goods in the short run at a fixed price. Managing risks, enter into a forward agreement to guarantee the exchange rate. That is very commonly do by the firms operating in different parts of the world for imports or exports. Use foreign currency options to lock in future in exchange rate if they move against, but benefit from the rates if they move in favor. So economic exposure. So these are transaction exposures that they are doing by the traders, or but there is an economic exposure as well, like the economy is not performing well in the foreign country. So long-term fluctuations come from unanticipated change in relative economic conditions, could be due to change in labor market or a government, or maybe more difficult to hedge. Try to match long run inflows and outflows in the currency. So that's very difficult to anticipate, and there is no solution for it as well. But for a transaction, we have a solution that we can buy a forward contracts. We can hedge the risk. But in an economic exposure, it's difficult to anticipate as well as it's difficult to cover. The only solution is that we have to do long-term projects or long-term contracts so that the economy is not going to affect. Borrowing in the foreign currency may mitigate some of the problems. So it is good that when you are doing some project in a particular country, so borrow from those countries' banks so that whatever is going to happen, your assets and your liabilities are at the same place. So that's going to be more sensible. Translation exposures, like income from foreign operations has to be translated back into the local dollars for accounting purposes, even if foreign currency is not actually converted back to dollar. So we have to convert. In the beginning, I mentioned that we have to convert the balance sheets, assets, liabilities, and also income statement into our local currency so that we can show as a consolidated balance sheet or income statement. So if gains and losses from the translation followed through directly to the statement of comprehensive income, there should be a significant volatility in earning per share. So sometimes we keep it as a separate. Current account regulation requires that all cash be converted at the prevailing exchange rate, with the currency gains and losses accumulated in a special account with the shareholders' equity. Now, managing exchange rate risk. So these are all the risks what we are discussing: transaction risk, economic risk, and also translation risk, like when we converting it. But the managing exchange rate risk, large multinational firms may need to manage their exchange rate risk associated with several different currencies. So the firm needs to consider its net exposure to currency risk instead of just looking at each currency separately. Hedging individual currencies could be expensive and cost may not be matched potential benefit. The last thing is the political and a governance risk, that political uncertainties. And as I mentioned in the beginning, that it is not possible that the firms can operate in a country where there is a law and order situation is not good, or there is a civil war type of situation. So political risk, change in value due to political actions in the foreign currency countries such as confiscation, or interruption due to war or civil unrest. Governance risk loss due to lack of transparency of foreign operations. And investment in countries that have an unstable government should require higher returns. So the extent of a political risk depends on the nature of the business. The more dependent the business is on other operations within the firm, the less valuable it is to others. So natural resource development can and be a very valuable to others, especially if much of the groundwork is in developing this resources has already been done. Local financing can often reduce political risk. Again, the same phenomena we are applying, like where you are generating assets, you should generate the liabilities as well, so that in case that we lose asset, so that we can also adjust the liabilities there as well. So this is all about, and we discussed different types of risk while doing operations internationally. So this is the way that we discuss. So the main thing here is we talk about exchange rate.